Welcome back to Retirement Today. I'm your co-host, Jonathan Berglund. With me here, as always, Michael Reese, certified financial planning professional for over 25 years now. And our focus here on Retirement Today is to help you get to and through retirement with confidence. And some of you out there might be thinking to yourself, hey, I may have a useful tool in my arsenal to maybe get me to retirement, but there's some tax consequences involved, and I don't really know what to do about that, right?
Yeah, I mean, I was talking to this was probably 6-7 weeks ago. I was talking to a couple who they had inherited land from their parents.
Yeah.
And this land was worth like $5 million. I mean, it was worth a really good amount of money.
Sure.
And they had no desire to keep the land, right?
Yep.
And the other issue is the way it was all structured. Like a lot of times when you inherit money like that, when you inherit something, you can sell it with no capital gains tax and it's easy.
Right.
The problem was that the way the trust had been built over the years, there was a cost basis attached to this inheritance. So if they sold, their tax liability would be dramatic. It'd be pretty significant. But they're saying, man, if we could just sell it and not pay a boatload of taxes, we could retire now.
Yeah, it's the golden ticket, right?
Right? And if you're in that position where you're saying, man, I've got a lot of real estate. People that have rental houses that they're trying to exit.
Right.
Right.
Yes.
They're saying, look, I'm done with the rental game.
Yeah.
I want to sell them. I've got a buyer. Or it wouldn't be hard to sell them, but
Exactly.
the capital gain would be dramatic. Like,
Yeah.
I've got $2-3 million of gains in these things. How do I reduce taxes? You got to call us before you sell. You got a business you want to sell. Hey, a lot of people out there, they sell their businesses, but the taxes on that sale are dramatic. Here's the problem. Their accountant tells them how much the tax is.
Here's your bill, right?
But their accountant never really tells them, look, here are ways, like creative ways that you could sell this company and reduce your taxes. So, again, you're in that position, call us. Mm-hmm. We're here to help you. 512-886-5850. Now, as we wrap up the show, I want to talk about a retirement account that a lot of people use. And again, this is a tax-related discussion.
Mm-hmm.
And I want you to think to yourself as I go through this list, I want you to think to yourself, wow, is that a good account for my retirement? Or is that an account I should avoid for my retirement?
Pros and cons, okay.
Right? So here are some characteristics, Jonathan, of this retirement account. And it's used by millions of Americans, just so you know. This is a very common retirement account. Number one, every time you pull money out of this account when you are retired, you're going to pay tax at whatever your highest tax bracket is. Well, by the way, I just described pretty much almost every retirement account.
Yeah,
right?
okay.
So it's not a big deal. But here you go, number two. Every time you pull money out of this account, not only do you pay tax on the amount you withdraw, but very frequently, it makes you pay more tax on your Social Security income, so you get double taxed. How's that feel?
Already not liking it?
Oh, but wait, we got a bit more.
Okay.
Every time you pull money out of this, number three, every time you pull money out of this account, you pay tax at your highest rate.
Uh-huh.
It may make more of your Social Security taxable.
Right.
It also oftentimes ends up making more of your investment income taxable, your interest, your dividends, your short-term and long-term capital gains. All of that investment income you have, you pay more tax on that too. So that makes it triple taxed. How are we doing so far?
Not feeling too great on that one.
Not loving it.
No.
Benny so far seems to be smiling.
He's thrilled. I mean, this
he
is
likes
his
it so
favorite account,
far.
I think.
As they say, but there's more. This is the only account. So you're saying, okay, I don't like any of that.
Mm-hmm.
I'm just not going to pull money out. I'll just leave it until I really, really need it.
Right. Yeah.
Well, it's also the only account that the IRS forces you to pull money out every single year once you hit a certain age, whether you want to or not.
Sounds like a rock and a hard place.
So it's like, I got money in this account. I don't want to pull it out because I got to pay all these taxes. But then the IRS comes along and says, too bad, buddy. You got to pull it out. So number one, every distribution taxed at your highest rate. Number 2, often makes more your Social Security taxable. Number 3, often increases taxes on dividends, interest, capital gains. And you're forced to pull money out even if you don't want to, which violates freedom in America. I thought America was supposed to be free. Okay, let's keep going. As you age, these distributions get larger, and very often what happens is as you're forced to pull money out, not only do you pay all these taxes, but guess what? Next thing you know, it increases the premiums that you pay on your Medicare and your drug prescription plan. So you say, hey, wait a minute, my Medicare premium went up. What happened? Well, what happened was you were forced to pull money out of this account, and the way the calculations work, now you got to pay more Medicare premium. So basically that's a stealth tax, yet another tax.
Right.
Right? Let's see, where are we? 1, every dollar you take out, you got to pay tax at your highest rate. Sometimes it puts you in a higher tax bracket. 2, every distribution, you end up oftentimes paying more tax on Social Security. 3, so it's double tax. 3, every time you pull money out, it often makes you pay more tax on dividends, interest, capital gains. 4, you're forced to pull money out even if you don't want to, right? 5, when you're pulling money out, oftentimes it makes your Medicare premiums go up and Medicare drug plan premiums go up. That's like quadruple tax.
Yeah.
How are we doing so far?
Not so great.
Now, here's the other thing. Highest taxed asset to leave to a surviving spouse or to children.
Yep.
So, you're thinking, hey, when I die, like I'm married to Becky, I would love her to get all of our assets tax-free. I don't want the IRS getting a chunk. Because here's the deal. When one spouse dies, the surviving spouse is a single taxpayer. Their tax rates go up.
That's right.
Here's a great idea. Let's leave to Becky, my wife, who becomes a single taxpayer so her tax rates go up, some asset that she pays a boatload of tax on. Does that make sense?
Not so good.
Like the opposite of what we want to do. And also worst asset to leave to children, grandchildren, again, because of taxes. The IRS becomes a huge beneficiary of your hard-earned savings. Mm-hmm. What did I describe? That, my friends, is 401k, 403b, 457, IRA, SEP IRA, all those retirement accounts.
Yeah.
While you're working, they are wonderful, wonderful tools to save tax. But the instant you retire, they go from a wonderful tax shelter to, from a tax perspective, the absolute worst account you can own. For most people, not for everybody, not for everyone. For most people, worst asset you can own from a tax perspective. So the question you should be asking yourself, if you have a financial advisor, you should ask the question, what strategies has my advisor brought to my attention where I didn't have to call them? They reached out to me and said, hey, you got all this money in these taxable accounts. What strategies are they giving me? Where are they giving me a glide path where I can go from where I am now, where all this money's sitting in these taxable accounts, to a place where I can enjoy zero tax brackets in retirement, or as close to zero tax brackets as is possible for me? Are your advisors, whether it's your accountants, if you have an accountant, your financial advisor, by the way, even if you have an accountant, your financial advisor should be doing this. That's their job. What strategies is your financial advisor giving you every single year to get you on a glide path where you would go from where you are now to where you can get to a zero tax bracket in retirement? Not everybody can get to zero, but at least as close to zero as you can. What strategies are they giving you every year to kick Benny, this ugly IRS tax monster, out of your life? And if they're not giving you those tax strategies, if you've got to call your advisor and say, help me with tax planning, here's the problem. What you really need is not an investment advisor. You really need a financial planner.
There you go. Yep.
You need someone, a financial planner who focuses on retirement planning. That's what you really need. And if you don't have that, you need to find out what having that is like. And the easy way to do that is you just call us. If you call us, if you're one of the first 10 callers, and I know we've pretty much probably already filled up most of that, but try anyway.
Yeah.
If you're one of the first 10 callers with over $500,000 saved for retirement, you want to call this number. Let's get a Retire Right report in your hands so you can see what financial planning is all about. It's so much more than just investing. Jonathan,
That's right.
Let's wrap the show up with that number.
Sure. Here's the number, 512-886-5850. Again, the number is 512-886-5850. Reach out to us, set up a time to have a conversation. We'll get you that Retire Right report and on your way.
All right, that's our show this week, gang. I hope you have a terrific week. We'll talk to you again next week.